Hi, here we are at week 11 now, and this week we're going to go over several things on how to get into the market, and then the last 2 days we're going to spend with our traders here, and we'll look at several different markets, several different charts, and we'll show you how we differ somewhat in our executive decisions and how we look at a chart to get in. So let's go right to the slides now. Our goal this week is to put together everything that we've covered so far and apply it to actual market conditions. Our goal for today, the first day of week 11, is to demonstrate how we pick a market that has good possibilities for trading. We're going to assume that you're not in the market, that you're looking around and trying to find the most profitable and the most probable profit decision you can make. Here's what we look for when we're looking for a tradable market. These are things to look at any market, whether you're talking about stocks, bonds, commodities, spreads, or whatever. These are the things we look for first. First of all, we want the market, the alligator, to be sleeping. We want the three balance lines to be intertwined and flat. And the longer it's been sleeping, the better it will be. A second thing that we also want to be happening with the alligator is we want it to be a saddle point. We'll show you what we mean. You already know, but we'll review it. We also want the market to be bracketed. We want a fractal buy on the outside of the mouth, and we want a fractal sell on the outside of the mouth. We also want to look, if we're looking for the end of a big trend, we want to look for our 5 magic bullets that will kill any trend. And then we want to look at the Elliott waves, which, as we know, is an ungrounded assessment. It's an estimate, but it gives us confidence to get into the market. Timing is of the utmost importance. It's very important. If you choose, for example, to start in trading 5 markets, and all 5 markets have just completed a third wave, you're going to experience a major drawdown, and you're going to be unhappy. However, if you're wise enough or lucky enough to enter 5 markets that are in an impulse, then you're going to experience great profits. And hopefully you're going to be wise enough so that you don't need the luck. In fact, if you're lucky enough to do it, there's a real negative outcome for that, because you're going to get what we call a little tin God complex, and you're going to think you know a lot more about the markets than you do. So our job here this week is to become wise at entering the market. Let's look first at a saddle point. As you know, and we're just reviewing here, a saddle point consists of 3 different elements. The first element is that the alligator must be sleeping. He must have his mouth closed and just sitting there. And again, the longer he sits there with his mouth closed, the better probabilities we have for making a big move. The second consideration is that the awesome oscillator needs to be right around 0, and the third consideration is that the AC, the accelerator, needs to be near 0. Now, this is a pretty good setup. It doesn't matter what commodity or stock this is. Anytime you see this configuration, this is a good setup to get serious. And we also notice we have a fractal outside the mouth here and a fractal outside the mouth. This happens to be crude oil, but let's go and see what happens immediately after this chart. Here's what happened. This is where we were. We had a bracket up and a bracket down. We had the AO was near 0, the AC was near 0. The market had been sleeping for a while, and the market breaks out, and we're triggered first. If we use this stop, we would be triggered on the upside and then with a small whiplash. And remember that we call this the low rent district. If you had placed your stops at a more outside fractal, you would not have been whiplashed. You would have been in short at this point. And you can see how the market dropped down through here. A very, very good trade, simply because we waited and were wise enough and patient enough to wait until the setup is just right before we enter a new position. Let's look at some more examples. Over here we had a sleeping alligator, but we did not have the second and third conditions. Here we had a sleeping alligator, but we didn't have the second and third conditions. We did, however, have 3 fractals outside the mouth, and we would normally take that. And the reason we would take that is because the alligator is opening his mouth to the downside. Now, at this point, we don't want to trade at all. This is a reaction wave. This seems to be a third wave, so we're going into a fourth wave, and we certainly don't want to do anything between the peak and the time it goes to 0.0. And then it moves up to here, and it starts a flat market. Now, as we get out to this point, we do have a tradable market. We are in a saddle point. The alligator is sleeping. We have buys above the market, sells below the market. The AO and the AC are near zero, so we would consider seriously entering this market. This is a good market to enter. One of the things that we might look at if we're looking for a longer commitment in this particular market, we might look at a higher time frame. Let's look at this higher time frame. This is a weekly chart, and on this weekly chart we can see that we have a number of interesting things that are happening. Number one, the Elliott wave. There are 5 Elliott waves present. 1, 2, 3. 3 is here, 4, and 5. Also, the 5 magic bullets are present, all 5 magic bullets. So we're expecting an end of a trend up here in the top. In fact, this may be the end of a trend because there is a bearish divergent bar at the top. And remember, a bearish divergent bar is one that has a higher high, higher low, and closes in the lower half. This also happens to be a squat. And the market is now in the red zone, which means that the momentum is down. Not only is it down, but it's accelerating down. And finally, we have a double divergence in the momentum. So this is a great deal of evidence that this market has indeed topped. It's also in the target zone. It would have to be in the target zone for us to have all 5 magic bullets present. Let's see what happened after this. The market came up, and it did peak up here exactly where on the weekly, this is where it peaked, and it had a significant fallout here, a very large fallout. So we would be ready to take that one. Let's look at the Elliott wave a little bit more. Here is a chart, and we're not going to show you the larger dimension chart. Let's just take this one by itself. What we know from the first thing we look at is that this is some kind of a third wave. Now, a C wave is also a third wave. And over here we see that this on the left, it has peaked. So this may be some sort of upward 3 there, and then a downward 3, or a wave C. We just don't know at this point. We'll follow through here and see how it falls out. But if this is a wave C, this has a suspicious looking correction about it. And notice that we have a fractal up here and a fractal up here. We're not in a saddle point. The alligator is not sleeping. The AO is not at 0, and the AC is not at 0. So we're not interested in entering at this point. But let's go further. This is in February, and this is where we were here. What we thought was a third wave down there turns out to be not a third wave, because now we can see that we have a lower momentum over here. So this is a third wave, or a potentially developing third wave. And remember that we're trading the church of what's happening now. We're not trading the Elliott wave. The Elliott wave is an opinion, and its design is to give us confidence to take the trade. But we do have fractals through here, so we definitely would take any fractal coming out of the mouth here, particularly when the mouth is open, and we would follow that through. We would be stopped out here. We would be back in on these fractals here. So this is a very, very nice run. Now let's go forward to the right even more and see what happens next. Well, what happens next is we have a point 0. This was the second 3. Remember, we thought it was 3 way up there, then we said no, this is 3, and now we're making even lower. So this is developing into a very interesting Elliott wave. But at this point, and this is important for today, we do have a saddle point. The alligator is sleeping, the AO is near 0, the AC is near 0, we have a fractal up, we have a fractal down. So at this point, we would bracket this market with a buy stop up here and a sell stop here, and then when this fractal was formed, we would lower that sell stop to there. The down fractal was hit, the alligator is opening his mouth, everything is going along just as it should do. Now let's look at a 5-minute S&P chart. On this 5-minute S&P chart, we had a saddle point here. We had the alligator with his mouth closed. AO and AC were both close to 0. And if we had taken this fractal down and that fractal up, we would have been short here. But we would have been long again up here, and this made a good move. This was a profitable move. Now the question is, what do we do now? We have some kind of a peak up here. We have a bearish divergent squat up here on the top, and the market is coming down, and the alligator's mouth is closing. Now when you see this projected out into the future, which most software will do, that will tell you exactly what that alligator is going to be doing 8 periods ahead of time, or 8 periods into the future. So let's see what happens. This is about 12 o'clock here on this 5-minute S&P chart. And let's go over here to 12 o'clock on this particular chart, which is right here. This was where the mouth was closing. And again, we have a short spell. The alligator didn't take a long nap here, but we do have a point zero. We have the alligator's mouth is closed. AO is near 0. AC is near 0. So we want to bracket the market. We want to take the first fractal out, which is this one in this direction, and this one on the downside. And we have a several hundred-point move here in less than 2 hours. This is the value of patience. This is the value of waiting until you get into a saddle point. And I know that most traders, if you're like us at least, we like to trade. That's what we do. So we sometimes tend to push the market a little bit too much and not be patient enough to wait till we get that saddle point. The lesson for today to review is to make sure that everything is just right before you enter a trade, particularly if it's the first trade in a campaign. And then tomorrow and the next day we're going to give you some more ideas about our executive decisions, and once again on Thursday, or the 4th and 5th day of this week, we're going to use the actual markets and some actual illustrations of real trading. So that's about it. Make sure you continue the morning pages and the AT, and have a good night. We'll be back with you tomorrow.
Okay, we're at week 11, day 2. Now this week there's a lot of information. You're now able to really understand a little more about executive decisions, about magic bullets, about squats, bullish divergence. So you're starting to see that there are many different aspects of the market. There are many different things that really are market conditions that make us choose or help us to choose where our stops are. Our goal for this week, or our goal for today actually, is to be able to recognize a wave 4 or a non-trending market and get the best trade location for the next trend without sustaining excessive whipsaws. Now, this is basically, this is really what I see in the markets most of the time. A typical trading market. You'll see a market come up, pull back, up, back, up, back, up, back. By the time this move takes off, which is only 15 to 30% of the time does a market trend, you have been whipsawed so many times in here that you're either out of money, upset, mad at the market, or you've gone on and moved to a new market. So this market takes off and you're not there. After this market takes off, you come back because you missed it, and where do you think you enter again? Right back here in a wave 4. So our goal is to be able to help you see a wave 4, know what to do with it, and if you choose to trade a wave 4, how to get the best location and what is the best time frame to choose to trade a wave 4 in. So this is an S&P on a daily chart. And what we want you to see, or what I want you to see, is notice this huge move. Okay, that's a wave 3. Look at your oscillator. You now know that that is a wave 3 by being your tallest peak. Now after the market moves or has such a large trend or a big move, what comes after a 3? Well, we know wave 4 is next. So what we try to do is avoid this area, these whipsaws, because what we also know is after a wave 4 is a wave 5. And we know that 1, 3, and 5 are our impulse waves. That's where you're going to make your most money. That's where we want to be in the market. Where most people lose all the money they've made in wave 3s, or some people never even have a chance to make it to a wave 3 because of a 2 or 4. So we want to go, what I want to do is talk to you about what I feel is best in a wave 4. Remember, all of us trade differently and all of us see different things in the market. We all have different account sizes. We all have different belief systems. So I feel like that there's enough tools here that you can find a comfortable stop or a comfortable way to get in and out of the market. So at this point, after trading, or after being, if I had been in this wave 3, I'm going to be much more likely to get in the wave 4, not to miss wave 5. If I have missed that entire move here, I don't want to get in here and sustain a lot of whipsaws. And what happens in a wave 4 is you'll see it gets larger and larger. You have a fractal here, you have a fractal here, you have a fractal here, you have a fractal here. Fractal, fractal, fractal. Now, for me personally, after that type of move, look at the length of this move. Okay, that took a couple months. I don't want to trade the wave 4. I know that after the market has been so impulsive, it has to pull back and it has to correct. So at this point, at the beginning of wave 4, I'm not even interested in being in this particular market right now. Now, this is an S&P, so it's a little wilder. Some of the markets are going to be different. Remember, each market has its own behavior. Each market acts differently. You know, I look at the markets as having different personalities, like children. If you have 7 children, you do not treat all 7 of your children the same. You may have one that's wild. You may have one that's quiet. You're going to have different personalities, so you're going to treat them according to those personalities. So I look at the market the same way. Now, in this particular slide, I want you to see this is a copper on a daily chart. Look at this huge move all the way down. So we know that was a wave 3. We've got divergence here. Now we've crossed 0. We're in an ABC, another ABC. So we're trading a wave 4, or this is a wave 4. Why? On a daily basis, there is no reason to trade this. This is where most traders get hurt. So we want you to be able to avoid it. But also, there's a lot of people that may want to trade this. If you decide that you want to trade this, the place to be, I think, is on an intraday chart, because intraday, this A wave and these C waves are also impulsive. So they have the same characteristics of a wave 3 and a wave 5. So let's go to the smaller one. Now here is a 30-minute chart. What I have done is broken down that A wave and C wave you just looked at. Okay? Now this is coming back on the downside. So this actually could have been profitable. But if you have tried to trade this on a daily basis, it would not have been as profitable. So again, what I'm saying is if you see a market go into a wave 4, it's just been in a very large trend, you may want to go intraday to trade it. You may choose to stand aside and not trade it at all. Okay, here's another example. This is an S&P on a 30-minute chart. It's been in a correction. Look at your gator. Look at it twisting and turning. Look at all these fractals. Up and down, up and down. If you took every fractal here, you would have been whipsawed. You'd have lost a good deal of money. And by the time this took off, you'd have probably been quite upset. But if you chose to be in here, 1, 2, 3, 4, 5, 6. Look at your consecutive red bars. The bar circled here is your exit. So what I'm saying is if you're choosing to trade a wave 4, you need to use tight stops because they move impulsively. If you're going to get in there and get some profit, take it off the table. Don't let it ride. That's my suggestion. That's when I'm trading a wave 4 or a sideways market or a non-trending market, that's what I do. Now in this particular chart, we're looking at the S&P now on a 5-minute basis. Now notice the saddle point here, how long the market sat balanced. And you're going to say, well, here's a valid fractal, here's a valid fractal, here's a valid fractal. Well, I'm going to show you in a few minutes what I normally do. Many times, instead of taking every fractal, I will pick an outer set of fractals, the widest set of brackets, to avoid this inner noise and make sure that I don't miss this move. So at this point, make sure you also watch the gator. The gator's going to let you know what the market's doing. You know, with CQG, we have the well, it's a plus. We are able to see projected out in time what's happening with the gator. So before it actually happens, many times I can see the gator's mouth opening up. So now is a smaller time frame, smaller than we were in the last chart. And look at your consecutive bars. I've circled your oscillator, your AO, and your AC. So you had 2, 4, 6 consecutive red bars. At this point, which is a squat bar, it's a 1-1 squat bar, that is where we were stopped out. So again, if you're going to trade a market that's been a little choppy, you're going inside time frames, you're going from a larger time frame to a smaller time frame to trade the impulse inside of a correction, you're going to want to keep a tight stop. Don't give that profit back if you've made it. Now here, this is what I'm talking about. By taking a further out fractal, you can avoid some of the whipsaws in a wave 4. So here you had your big move, right? And then here's your fractal and your fractal. Now these are the outer two most fractals at the beginning of this wave 4. Now remember, I don't want to get right in the beginning of a wave 4. I would rather get in, hopefully, in the C wave, or hopefully I get in right at the beginning of wave 5. But there's no way for us to really know when a wave 4 is going to end, how long a wave 4 is going to be, or how complex or simple a wave 4 is going to be. So What I have found and what we've found in trading is sometimes coming into these outer fractals and bracketing those helps us to avoid all this whipsaw, all this excessive loss through here. Now, and I also watch the gator's formation. If the gator is not shut tightly and spent some time shut after a move like this, I'm going to be more cautious. So where I have circled is where I had my first set of brackets. In case the market takes off again, I'm not going to miss it. Now, you may say, well, that's not very good trade location. But if you think of it this way, if I were to have taken every signal here and been whipsawed, think about how many points down I would be. Let's just say 50 points against me. Now, the move takes off and I get filled here. Well, I may not be at the beginning of the move here, but I'm not already down 50 points trying to catch up. So I may actually come out of it much more profitable than the person that's taken every signal. So by taking the further out fractals in the beginning of a wave 4, it really may help you to miss this congestion and miss this noise. Now I've circled this fractal because after the market has made these moves, I have changed my down fractal from here, and now I've changed it to here. Because what I'm thinking about also is if you're looking at, and you know a little of Elliott wave now, the last move was up. The general trend is up. So what's going to be coming down are going to be my A wave and my C wave. Well, I don't particularly enjoy trading fourth waves, and especially this is a daily chart. I don't want to be in here. But I don't want to miss the next move. I don't want to miss wave 5. So I'm absolutely have my buy stop here, had my sell stop here, moved it to here. Now, at this point, I'm going to wait and watch the gator's formation. If the gator starts to open up, I may change my buy stop and lower it down a little bit. But at this point in time, that's where I have my buy here and my sell here. Now, here's another example. You had a buy and a sell here at the beginning, and it helped you avoid all of this noise. Now, we've created another down fractal here that you might have chosen to take. Here's another down fractal. This was the one that I have circled because I chose this one next because it was lower than this previous down fractal. Now, you were hit and you did sustain one whipsaw. The market pulled up and closed above the red and the green line. So you were stopped out here, but look, we've created another down fractal. So if you were stopped out, you were right back in. If you never used those fractals and decided to wait till you saw the gator opening, now you're in here short. Look at the gator's mouth. It's wide open. Look at your oscillator. And notice the saddle point in which this came out of. Okay, that's very important. That saddle point, we know when the market stays balanced for a long period of time, the move is usually explosive, or it's usually a bigger move the longer it stays balanced, because the market cannot stay balanced forever with no new coming information, or we wouldn't have any markets to trade. So at this point, here's your entry or re-entry, or here is your first entry if you missed all of those. You see the gator's wide open. Now, if you choose to be in here after your 5 consecutive bars, I want to be stopped out. I want to take my profit. This is a 5-minute S&P chart. Now, you as a trader may say, hey, I see the momentum, I see that the peak is increasing, I may choose to stay in here. My point to you is all of our stops are executive decisions, where we place them, where we get in and where we get out. But you just need to note the different market conditions. That's what tells me, or lets all of us know, where should I be or where should I not be. Now in this one, here we go, the market's come up, it's pulled back, and this is a 5-minute chart again. We're looking at some volatile markets. Here you had 5 bars, it's pulled back, and again you've had another 5 bars. This is where I've placed a trailing stop. I'm going to protect my profit in the market. If the market decides to pull back, now I have blown this up, this is a correction, but it's an impulse inside a correction. So I want to make sure I get the most out of it. If the market's going to give me this money, that's great, but why give it back? We'll place a trailing stop and continue to follow it up 1 tick below the low until the market takes us out. So this is the end of day 2. This is probably one of the hardest places to trade in the market. Go over your computorals, fax us, email us, practice yourself, but remember, all of your decisions are executive decisions, and most of them are based on your belief system. So look at the market, read what the market's telling you, and make your decision based on that.
Today, we're going to talk about something that should be easy. In fact, the easiest thing in the world, you would think, would be to follow a trend in the market. And yet, most traders find that the most difficult thing to do. So today, we're going to spend our time looking at trends and how to trade them. We're going to talk about what creates a trend, why a trend is there. We're going to talk about how to use stops in the trend, whether you feel real confident or not so confident. And we're going to talk about how to trade the trends outside the Elliott wave and trade the trend using the Elliott wave. Here we are at the slides, and our goal for today is to learn more about trading in that best of all trading places, a trending market. And remember that a trending market should be the easiest place to trade, but for most of us, we find it very, very difficult to follow the trend. Let's define what a trending market is. First of all, the best definition, and the most easiest one to see immediately, is that it stays out of the alligator's mouth. Number two, the pullbacks are less than the thrusts. Obviously, it couldn't be a trend unless the thrusts were greater than the pullbacks. And it will contain more green bars in an up market, and obviously in a down market is going to have more red bars in it. Let's take a look at an actual market itself. Here's the daily chart of the S&P, and we've seen this chart before. You remember this is the big run-up between February and the middle of April. And notice that in a trend, the price bars tend to stay outside the alligator's mouth. Remember that our first fractal out of the mouth was where you would have gone long, and as long as the markets, the prices, are outside the alligator's mouth, then you know that you're in a trend. Not only do you know you're in a trend, you also know that you are in an impulsive wave, in an Elliott wave. Note that up here at the end, though, the alligator's mouth is beginning to close. Now, you know from past lessons that that means that the trend is probably coming to an end. And so you would look to get out, and you would look to take profits as quickly and as easily as you could. Let's take a look now at how we would do that. In any uptrend, also, we'll have more green bars and red bars, and again, this has to do with the thrust and the pullbacks. And in a downtrend, you'll have more red bars than you will have green bars. The problems of trading a trend is twofold. Number one is when do you get in, and number two, and more difficult, is how do you handle pullbacks. You must make an executive decision whether or not you're committed to this trend. Now, if you're committed to the trend and you have confidence in your position, obviously you're going to have a much more staying power than if you're not. In the market, they call these the strong longs or the strong shorts, and those who don't have that ability are called the weak longs and weak shorts. And on the floor, you'll oftentimes hear them talking about we have to get the weak longs out before we can go short, and vice versa. Let's look at this same chart again. And if you're committed to the long term for all kinds of reasons, then you would probably want to use the furthest backstop, and that furthest backstop is the red line, as you know already. Another stop is at the green line, and then you have the 5 consecutive bars, and you have the signal in the opposite direction. And you know all of these from previous sessions. So let's look at what trades to take in a trending market. You only take those trades that go in the direction of the trend. You don't take any other trades. If you do, you're feeding the alligator. And you consider making an executive decision not to add on the zone trades after 5 consecutive bars of the same color. We know that when you have 5 consecutive bars, you are in a good market, but a market has to breathe. So after 5 consecutive bars of the same color, we get very, very more cautious. We don't continue to add on the zone trades on the stop-close onlys. For example, down here we had several green bars, but we only had 4. We had 5 green bars there, and the market did not take a breath, but it did not go lower. And then it took a breath up here. We had a bunch of gray bars, but notice that we had 5 red bars here. But we're above the alligator's mouth, so we would not be short by any means. Then we have more greens, a few reds, a lot more greens, a few reds, and more reds here. Notice in this area, we're having more red bars than green bars, which again, with the alligator closing its mouth, gives us an idea that perhaps this trend is going to be over. Then the next question, obviously, is where to place stops. And where you place the stops, again, depends upon whether you're a strong long or a weak long, or a strong short or a weak short. If you're a well-financed trader, if you're committed to the trend, if you have all the grounded assessments for staying in that trend, then it would be foolish not to follow the market. Remember that the Holy Grail is wanting what the market wants. You also have, and we all are this at one time or another, the scared, unsure, afraid trader. One of our rules here is that the most valuable commodity you will ever deal with in your life is your perspective. So you want to watch your perspective closer than any other market or any other commodity in the world. So if you're in an unsure, afraid place, you may want to just exit the market, get out, and come back when you're feeling better. Trading in a trend. There are two ways to trade in a trend. There's the Elliott wave, and there's trading without the Elliott wave. The Elliott wave is not a necessity. We've already pointed out that anytime the prices are outside the alligator's mouth, you're in a trend move, and when it's inside the alligator's mouth or going back and forth, you're in a reactive move. The Elliott wave basically is an ungrounded assessment, so it's an opinion. So we do not take any trades based on the Elliott wave itself. We have to have a grounded assessment. But if we know that we're at the end of a wave 2, then we would trade much, much more aggressively than if we thought we were at the end of a wave 3. So let's look at the Elliott wave. Here we're trading with the Elliott wave, and we're still looking basically at the same chart. And notice that we know from our Elliott wave count from the awesome oscillator, we know that we're at the end of a wave 3. We have divergence, we have the 5 magic bullets, and the alligator's mouth is closing. When you add all of that together, then you would anticipate the market going into a fourth wave. And again, remember that that's where 85% of all of our whiplashes happen. Now let's look at what happened immediately after this. Let's go further. This is where the first chart ended, when we were seeing all the alligator projections closing, and it went into a fourth wave. And for the months of April and May, if you were trading on a daily basis, this was an impossible market to make money in. So knowing where you are in the Elliott wave, the primary reason for that is to give you confidence to want what the market wants and to stay with the market or to exit at a strategic position.